Honorable Minister at the Ministry of Trade and Industry, Members of Parliament, government senior officials, CEOs and MDs of financial service providers, development partners, BNR board members, Honorable Governor of the National Bank of Rwanda, welcome to you all and good morning. Welcome to the Monetary Policy and Financial Stability Statement. The National Bank of Rwanda appreciates your response to the invitation and your candid participation to this MPFSS. I am Ingrid Chuzuzo. I work in the Financial Sector Development and Inclusion Department, and I am pleased to be your host this morning. As per our agenda, we'll follow the Monetary Policy and Financial Stability Statement from the Governor of the National Bank of Rwanda, Honorable John Rwangombwa. In addition to the statement, the National Bank of Rwanda will launch to the industry a set of guidelines for deepening women's financial inclusion. We'll receive comments and questions for each of the sessions, so ahead of time, again, we appreciate your interactions. We also invite you to interact not only in the room, but also through our social media, through hashtag MPFSS 2023, and that hashtag is applicable on Twitter, Facebook, and Instagram. For people who are not able to be with us physically, we are live or through our YouTube stream, and we are also happy to receive your interaction today. For the media in the house, there'll be a press conference after today's agenda, and you are all invited to come and ask further questions to today's program. Now, ladies and gentlemen, allow me to welcome the Governor of the National Bank of Rwanda for his statement. You're welcome, Governor.
Yes, good morning, and welcome to this year's the second MPFSS for this year. So, Honourable Minister, Honourable Members of Parliament, colleagues from the financial sector, our development partners, protocols observed, welcome to this morning session. Turabamukije mwese, turabakiriye muri iki kiganiro tugiye kugirana namwe, tubashimira ko mwemeye ubutumire bwacu kugira ngo tuganire uko ubukungu buhagaze, uko urwego rw'imari ruhagaze, ariko tugaruka cyane cyane ku bireba Banki Nkuru y'Igihugu. So this morning, as said by Ingrid, we will really focus on the economic performance for the first half of this year, and then zoom in or focus mainly on BNR's mandate. That's how we are doing with the monetary policy, how we are doing with inflation, and then on the financial stability. And we'll be happy to receive feedback from yourselves. We've tried to summarize a bit more than we normally do, the presentation, to allow more time for interaction. But I'm sure you all have access to the detailed document that gives detailed figures and information around the performance of the economy and the financial stability in general. So as always, we start with the performance of the global economy to put into context what affected what affected our economy in general. So, and as we always say, we get this from the Monetary Fund, the International Monetary Fund, mainly that's where we get these numbers. So as you can see on the screens, the global economy slowing down this year, is projected to slow down this year after a big recovery in 2021 and 2022, from 3.5% growth achieved last year to 3% projected for this year and 2024. And this is mainly driven by tight monetary conditions. Again, as you've been following, most of the central banks globally tightened their monetary stance to deal with the high inflationary pressures that almost every country had over 2022. And this has, of course, really tightened the financing of the economies and has affected or has contributed to this slowdown we see in the global economy. There's also tight fiscal space. We had challenges. We've had shocks from COVID to the Russia-Ukraine war, all that has affected countries and has really squeezed their fiscal space or their abilities to finance their budgets. That impacts on the economic performance in general. Global or geopolitical tensions still persist. We still live with the Russia-Ukraine war and other lingering challenges here and there. So that also contributed to the slowdown of the global economy, and climate change, of course, is affecting us all. And that will be coming back to that when we come to the national economy. Same story with Sub-Saharan Africa, though the decline is not as big as at the global stage, so declining from 3.9 to 3.5% this year. As I said, the inflation that was really high in 2022 pushed central banks to take tight monetary conditions or tighter decisions. But what is good to note is that this year we see prices going down. Mainly here we focus on commodity prices. Both the energy index and the non-energy index. Non-energy index mainly includes food items, fertilizers, and the likes. All these are going down. The first half we saw even a bigger reduction for the energy index reducing by 30.4%, and overall we project this to reduce by 25.8% during the course of this year. Same with non-energy index, reducing by 14% in the first half, and expected to reduce to negative or to by 9.6%. And this has food commodities going down. The fertilizers have really gone down. And fertilizers is linked to the reduction in gas prices. And gas is the main contributor to raw materials to fertilizers. So this is contributing to overall reduction in global inflation. So last year we had high inflation global at 8.7%. And this is expected to slow down to 6.8% this year and 5.2% next year. And that is contributing to slowing down of the tightening of the monetary policy conditions across different countries. Sub-Saharan Africa is also reducing the inflation, but though still high at 14%, and it's mainly linked to climate change, food issues in different African countries. And this reduction in inflation is also linked to easing of supply disruption that we had from the COVID time that really had impacted on cost of logistics. So coming now to the domestic economy, as I said, we'll try to summarize. So that was the summary of the performance of the global economy, as we saw reduced economic performance, reducing inflation. Now when we come to the domestic economy, we see strong performance in the first half of the year. I think the last numbers were released this week for Q2, just 2 days ago by the Institute of Statistics. We had registered 9.2% growth in the first quarter of this year, and the second quarter was 6.3%. So we see strong performance in first half of this year, but has started slowing down. As you said, we had 9.2% in the first quarter, and we had 6.3% in the second quarter. And we expect overall, I think the projections we have is 6.1% growth this year compared to 9.2% we had last year. So, but we still see strong recovery for the domestic economy, mainly driven by the service sector. There's been big resumption in the tourism sector, and the tourism sector has a lot of externalities, so that has contributed to the high growth in the service sector. Industry sector has also continued to grow, and again, as we see in the external sector, that has also contributed to increasing our exports. Unfortunately, agriculture has really performed poorly for 2 consecutive years now. Last year, we had poor agriculture performance because of bad weather. Same story this year so far. The first half of this year, we see agriculture growing by 0.3%. In fact, the food items are growing negatively, and that has impacted on inflation, as you see. So generally speaking, good performance, overall performance of our domestic economy, expected to remain strong for the rest of the year, though lower than what we achieved in the last 2 years. On the external sector, I normally say we have like mixed feelings or mixed story. Good performance in our exports, merchandise exports continues to increase strongly at 11.2% in the first half of this year. But we saw imports increasing much faster than the exports. And the imports are increasing linked to the good performance of the economy. Normally that would be a good story as well. But it becomes a difficult story when you look at our balance of payments, because the trade deficit increased by 23.3% in the first half of this year. And that has greatly contributed to the pressures you see on our foreign exchange market. So in the first half of this year, our flour rand depreciated already by 8.8% against the US dollar. I think today we've gone above 12%. The last time we had high inflation was in 2016. I think we had 9.7%. So this year, because of this high growth in import bill linked to the good performance in our economy, has really surpassed the good performance we see in exports. So that has impacted greatly on our exchange market. Though we have good performance on the other parts of the balance of payment, that has eased this pressure on the trade deficit. So we see service exports increasing, and mainly traveling to the tourism that I just said, increasing by 44.3% in the first half. Foreign direct investment also picked up this year from the pressures we had during the COVID time, and remittances have continued to increase. In fact, remittances this time are contributing much higher in terms of foreign exchange resources for our country. And again, at least the comfort here that we are still have strong reserves for the country at 4.4 months of imports by the end of June. So the pressures we see on the exchange market are expected to continue to the end of this year, but we expect it to start easing next year. On inflation, which is our main focus as the Monetary Authority, last year was really challenging, increasing throughout the year to a peak of 21.7 in November last year, and started easing from December that time. And as we had projected, we see it going down to, though still high, at 12.3% in August this year. But we still expect it to go to around 7.6% average for Q4, and below 5% as we show in the outlook for next year. But that, of course, depends on how agriculture performs. So when you look at the breakdown of the numbers, core inflation that is mainly composed of imported food, medicine, all other consumables apart from fresh food and energy, has continued going down, linked to the reduction in the global inflation as indicated earlier. Decreasing from 15.4 in December 2022 to 8.4% August this year. Energy inflation has also gone down, linked to the reduction in the global energy prices. Fresh food has gone down, but still really high, gone down from high of 50.1% to 29.8%. So though there's a reduction to almost half of what we had, but it's still high, and that is what is keeping us at double-digit inflation by end of the last 2 months. In fact, as you see in July, it had gone down, peaked a bit in August, because August is preparing for planting season, so food prices really went up again. We expect this to ease slightly due to production of season C, maybe in the next 1 month if possible, but we expect it to start going down in November, December when season A of last year starts kicking in. But the other components, we expect it to remain with that downward trend. That's why we are confident that next year we should be around 5%, depending on how agriculture performs. So linked to these inflationary developments, the monetary policy trends followed the pressures we had on inflation. We had to take actions to deal with inflation. So as you remember, we increased our policy rate from 4.5% February last year to 7% by June this year. Again, as you remember, in our last monetary policy, we decided to increase this to 7.5%. And this is really to deal with the pressures we see on the market of inflation. And normally we follow the transmission of our decisions in interest rates, and we see immediate transmission in the short-term interest rates, especially the interbank rates. As we increase from 4.5 to 7%, we see this increase in short-term, what we call the interbank market rate, from 5.4 in first half of last year to 7.55 in the second half of this year. And as we increased our policy rate to 7.5%, the interbank rate has gone up to 8.1% by August this year. So there's quick transmission in the interbank rate. Same with the short-term T-bills that has been increased. You see that in the detailed document. So the government borrowing has also, the rates have been increasing following the increase in our policy rates. Deposit rates has also started picking up, as you see, increasing to 9.55 from 7.48 last year. And this is not just an increase in terms of the rates, but also the depositors have changed in terms of the maturities. They have shifted to mainly, the biggest deposits have shifted mainly to 3-year maturity that attracts higher inflation, higher interest rate. So we see movements on all interest rates except the lending rate that is still a bit sticky, around 16%. And these could be many factors. I'll be coming back to the credit risk developments in the part on the monetary, on the financial stability side. So you see improved credit risk, and also there are many factors determining the lending rates. But as we see the other rates shifting, we would expect the lending rates to start shifting upwards if the pressures would continue. So we expect the pressures to start going down next year. But if they continue, automatically we would expect to see the lending rate following the other rates. So that's the story of the monetary policy and how it has been transmitting in the interest rates. Of course, our main target at the end of the day is impacting on the lending to the economy, and but there are other factors that have really slowed down on the economy itself. So which slows down the demand and automatically will slow down the pressures on inflation and pressures on exchange rate as well. So on the outlook, I think I've already said this. We expect to see inflation continuing to ease to around 7.6% in the last quarter of this year and to around 5% next year, mainly due to the monetary policy decisions, but in a big way due to government decisions that helped to ease pressures on some commodity prices. And we expect the government measures that have been taken to try and improve on our agricultural performance to really have an impact on the season A next year that could have a bigger impact on the inflation going to our medium-term objective of 5%. There are still risks around these projections. One is the geopolitical tensions. We still have challenges with the war in Ukraine, oil supply cuts. We see OPEC cutting their oil supply, and that has impacted on the price. I think you saw that over the last 1 month, price has gone from mid-70s to around 90. But at least the global projections we see indicates that it won't really go back to hundreds. We expect it to remain around 80% in the medium term. Climate change remains our biggest risk to our inflation outlook because it directly impacts our agriculture, and that's a big component of our inflation numbers in general. So that was the summary on the monetary policy side. Then on the financial stability side, I think the story has been positive for more than 3 years now and remains to be positive and even stronger going forward. So at least we continue to see our financial sector growing and deepening. So when you look at the sector as the sector assets as a percentage of GDP has grown to 63% from 61% average over the past 5 years. And with all the sectors, as you see all the sectors, the banking sector, the microfinance sector, the insurance sector, all registered double-digit growth. And for the last 3 years, they've been growing. So here overall assets growing by 18.3% to 9.6 trillion from 8.1 trillion in the first half of last year. So focusing on the banking sector itself, we see the lending, which is the main activity, increasing by the outstanding loans increasing by 17.3%, and this was mainly driven by new authorized loans, increasing above 30% in the first half of this year. Same story with the microfinance institutions. Again, we saw lending microfinance institutions to the private sector increasing. When you see that exponential growth, the line in between that goes up like this, that's for other circles. I think we indicated this in February last year, that this was mainly attributed to sharp increase in lending from Mwalimu Sacco to teachers after the increase of their salaries by the government. So that has seen big growth in loans to the teachers, and which really drives the loans in the microfinance sector as well. The credit, as I said earlier, we see credit risk really improving, both in microfinance and in the banking sector. When you look at the banking sector, the non-performing loans ratio has gone to 3.6%. I think for 2 consecutive years, we are below our benchmark of 5%. And it's not just the ratios that are decreasing, but even in nominal terms, as you see from 2021, it decreased to in lower level in 2022 and sort of stabilized there. Though write-offs contribute to this decrease in NPL's nominal numbers, but the good thing is we see the write-offs also reducing. When you compare last year, first half of last year to second half of this year, it has reduced by more than half of what was written off last year. We've also seen improvements in recovery of written off loans over the last year, which is also positive. So the same story with microfinance institutions. We also see their non-performing loans increasing. So there's good performance of the borrowers themselves linked to the good performance of the economy, contributing to these healthy numbers in the quality of loans, but also improved performance of the financial institutions in terms of the underwriting practices. So that has really helped to see reduction of the credit risk, which, as I said earlier, contributes to the pricing of the loans themselves. Not seeing any increase so far with the inflationary pressures that we've seen, and with increased policy rates, this contributes to that. Now focusing on the stability indicators, the banking industry remains really sound. When you look at these stability indicators, the first the capital adequacy ratio, is the measure of the capacity of the banks to withstand any shocks. It's really a measure of their capital base vis-a-vis the risks they underwrite, and this remains strong. Our minimum required capital adequacy ratio is 15%, and banks have maintained this above 20% for quite some time. So to June this year, it was at 21%. So despite the write-offs that we've seen, the capital adequacy ratio remains strong because banks have been making profit, and most of that has been retained to beef up the capital base and give them capacity to continue lending to the private sector and continue growing their business. I've already talked about the NPLs. This remains really below the 5% benchmark for 2 years consecutive now. And the liquidity ratio, their capacity to meet the demands of their customers in terms of liquidity, this also remains strong. Our minimum requirement is 100%, and this has remained above 200 for quite some time. So this table is what we focus on as the regulator. This is our main interest. How stable are these banks? And these are the main measures. Of course, there are others in terms of governance, in terms of other practices, but when you look at the performance, it really speaks well to this stability table that you see here. Which is the same story with microfinance institutions, also strong capital base, reduced non-performing loans, as I had said earlier, and strong liquidity buffers they have to serve their clients. So the lending financial institutions, both banks and microfinance institutions, remain strong and stable, and they've been able to serve their clients. As you saw in the credit, they've been increasing lending to the private sector. On insurance sector, we normally focus on the private insurance sector because the two public insurance companies are really strong and solid. We don't have any big concern on their stability. So here we normally track and present the performance of the private insurance companies or sector. There's been really improved performance of this insurance sector for over the last couple of 6 years. I always take 17 as a benchmark because that's where we are almost losing the insurance sector. They had gone to the worst they could ever achieve with high losses, a lot of malpractices. But from then there have been reforms and they've been improving in terms of their performance. And so part of the measures we look at is their claims. And so normally the claims ratio shouldn't go above 60%. So as we see in the first half of this year, it was on average around 57%. And for once, the insurance sector is making an underwriting profit. They've been in losses for more than 7 years. But for once, because medical and motor insurance are doing better, they're able to make underwriting profit. And that is a measure that shows the stability of the insurance sector. So that's a good development we monitor. And their stability indicators we follow, it's a solvency, their capital based on the risks they undertake, because that's the business of the insurance anyway. So we normally require that the minimum solvency margin should be around 100%, and they've remained strong around over 256% in terms of their solvency margin. And liquidity has been improving. Over the last 3 years, we've struggled to meet liquidity at industry level, the liquidity ratio above 100%, and this been able to achieve it in the last 6 months. So I would say really insurance sector is promising. Now what remains is sort of the fighting period is sort of overcome. Now what remains is to grow the sector in terms of products and reaching more customers and deepening the insurance services within the economy. The pension sector still remains strong. The first part talks about RSSB. We saw their assets growing by 16%, and this remains strong and with diversified investments and increasing contributions. So at least we see in the medium term a strong performance of the pension sector. And the Ejoheza, that is really a good product that came into being not long ago. So we see Ejoheza has continued to improve in terms of the number of contributors have been increasing, and their assets have been increasing as well. There's been a lot of mobilization around. And this, while the assets are not that as big as RSSB, but at least the number of contributors, the number of Rwandans that now have pension savings have been increasing, which is good for the stability and safety of our citizens. So this came really to cover the excluded citizens that were not part of RSSB, and so we see more coming on board, and that is a good development. For the first time, we are presenting this table on non-deposit taking institutions. These are new sort of mandate of the central bank. We are now overseeing or regulating leasing companies, credit guarantee schemes, trust and company service providers. These are linked to Kigali International Financial Center. And then there's the lending-only institutions. So it has been growing in number. So far we have now 37 non-deposit taking financial institutions. And they are, as you can see, their assets and their lending to the private sector has been also increasing. So this is a new development that we took on not long ago, and we see positive developments as well. On the payment systems, which the last part of this financial stability presentation is, again, which is sort of similar to the presentation we've had over the last couple of years. We continue to see good developments in the payment systems or digitizing financial transactions. So active subscribers have really increased by to 6.3 million from 5.4 million last year. And we see new fintechs coming into this space. So last year or the last 6 months, we've licensed 10 fintechs supporting the ecosystem of digitizing our payment systems or our financial transactions. Number of transactions have increased. Active merchants, I think this is one interesting development. As you remember, during COVID, we see a big growth in terms of merchants accepting digital payments. It had grown then when fees were introduced in 2021. We see this dropping. But with campaigns, government working with the service providers, we see a really big increase or a big uptake of these merchant codes and facilities. So increasing from 52 last year to 250,000 this year. All this has contributed to the value of electronic transactions as a percentage of GDP growing to 160% from 11% last year. In fact, by 2020, we were below 50%. So there has been exponential growth in this over the last 2 years. So these are just key developments. We talked about RIPS upgrade over the last 2 years. We've been upgrading our payment system. And this now is fully operational 24/7. For once, we brought in non-bank financial institutions. 11 microfinance institutions are onboarded directly on our RIPS. And now their clients can transact directly with the clients of the other banks electronically or digitally. The other new development is the Rwanda interoperability switch, the eCash. So far, 1.8 million registered users. Just started linking Airtel and MTN mobile money. So we expect this to grow even faster when they integrate with the banks. And we think by the end of this year, most of the banks will be already integrated into the RNDPS. And then going forward, we expect them to introduce single merchant code for merchant transactions, which would completely change the transactions within our merchants or within buying and selling of goods. So this has been the key drivers of this cashless campaign. So as I conclude on the financial stability outlook, as I said earlier, we expect to see continued sound and stable financial sector. All the indicators are really strong. So we don't expect any shock, at least in the medium term, what we can project from now. Of course, as a central bank, as a regulator, we continue working closely with the service providers to avoid any shocks that could disrupt the performance of these financial institutions. And so we closely work with the banks, microfinance institutions, insurance, and so. But as we said, at least today we have strong capital, we have good liquidity base, we are digitizing these financial transactions. So the base is really good, the environment they're working in is good, and we expect to remain resilient going forward. So thank you for your kind attention. That's the summary of the monetary policy and financial stability statement. Thank you.